All right, guys, welcome back to this amazing session. This is futures trading. I gave a lowdown on what futures is, but I'm going to reiterate that here again on this session, right? Now, futures trading is actually a contract. It's a contractual based market, right? It's a contractual based market, contractual based market, whereby you go into a contract betting on the asset to either go up or down and making your what profit. Now, you do not own the asset, unlike spot trading where you buy and retain the value of the asset. Here, you are only trying to bet if the price of the asset will go up or go down. And either ways, you can make money. So you can make money by predicting the market going up, or you can also make money by predicting the market going down. Now, one important thing you need to notice is that here on futures, buy means long, okay? Buy means long, and to sell means short. So you can use these terms interchangeably. They both mean the same thing. All right, when you are buying, it means you are longing. When you are selling, it means you are shorting the market down. Now, another important aspect you need to also be very, very cautious about is that when you go into a trade, you can take a leverage, meaning if you have $100 in your account and you want to make more profit, risking less, you can go with a leverage. Now, the leverage enables you to have a higher capacity of trading. I'm going to explain. It enables you to have a what? Higher capacity of trading. Here is the leverage. You can see if I click there now, if I click here now to show me leverage, I just leverage 50 is the highest for this coin on Bybit. Other exchanges have their own limit. This coin could be as high as 70, 120 on other exchanges, but on Bybit, it is pegged at 50 for the word maximum. All right, now it's pegged at 50, so I'm just going to exit this. So leverage basically is you saying I have $100, but I don't want to risk $100. I want to risk just $10. But I want the exchange to borrow me times 5 of what I want to risk. All right. So if you are risking $5 out of $100 and you want a multiplier of 5, you can basically just say, I want to use 5x leverage. Now the risk and everything will be calculated. So you can come here and adjust this to 5. All right. Now, basically, that's just it. Very simple. Now, under the margin mode, we have two types. We have the cross, we have the isolated. Now, this margin mode, first of all, what is a margin? A margin is basically, your margin is basically how much you have deposited in your what? Futures or perpetuals trading account. Right here, we have just $15. All right. I'm doing this just because of tutorial base, right? I didn't really fund much. I didn't have access to enough naira from one of my accounts today, so I just funded $15 for the purpose of this tutorial. All right, so $15 is what we have here. Now, as low as $15, you can still trade. You can trade perpetuals, but ensure that your leverage is very small. Now, under the margin mode, we have two types. We have cross, we have isolated. Cross margin mode simply means that when you fund your account, all right, let's say with $100, if you are opening two positions, meaning if you are opening a buy trade on Bitcoin and you're opening a buy trade on Ethereum, the $100 will service both trades, meaning your positions that you have opened are now crossed to your margin balance. That's why it's called cross. It is crossed to it. But on the other end, we have isolated. This is cross margin. This is isolated margin. On the other end, we have isolated margin. All right. Now, isolated means you have $100 and you want to take two trades, $20 each. The $100 will not serve as a collateral for you to service that trade. It will not serve as the margin, to service that trade. All right. It's going to serve as your $20 is going to serve as your own margin. It will be isolated from your balance, meaning every trade is standing on its own. $20 for Bitcoin trade, it's standing on its own. $20 for Ethereum buy trade is standing on its own. All right, that's basically what that is. Now, what else? What else? You already know what this is for. This is the percentage of your USDT that you want to trade with. Are you using 10%? Are you using 20%? 50% of what we have here, $15, it will be $7. Yeah, 7 point something dollars. All right, so basically that's just it. Simple, not difficult at all. Then TPSL. Your take profit is the amount that you want to actually close the trade in profit. So you can set your take profit here. You can just randomly set it. It depends on you. Are going to take a live trade actually. So I'm going to use a very small amount. So now let me take this trade, live trade. I want to show you how it works. Atom USDT. I want to go into a long trade. I'm using just 5% cross mode. Let me see, 5x. And I want to take this trade is a downtrend from here. I want to take a sell trade. So I'll just say my stop loss will be higher than the current market price. Let me put my stop loss somewhere around 8.740. So I'll just put it stop loss 8.740. I want to sell this trade though. I'm predicting that the market will go down. So my stop loss will be higher than the current market price, meaning if price should go up against me, this is the amount I'm willing to lose. I don't want to lose my entire $15. So I'm just going to put that there, which is 8.740. And my take profit should be around, let me confirm this first. My take profit should be around 8.365. All right, let's say 8.365. All right, so basically, if I initiate this trade, this is how much I'm willing to lose, 0.1 cent, and how much I'm willing to gain, 0.0467. Let me reduce this a little. Let me put it 8.0. So I'm risking 0.1 to get 0.19. All right, that's what I'm risking. So I'll click on confirm, and then I click on sell short. Oh, it says the minimum amount is 5. That's too small. It's too small. Let me increase it to 10%. That was too small. All right, so I'm initiating it right now. I'll just click on confirm, and you see the trade will start running under your word positions. So the trade is already running right now. This trade is running currently. You can see it is currently running. To start moving now, according to the percentage of which it's moving with. Got it, 0.01. This percentage here, you can see unrealized P&L, that's unrealized profit and loss. It is unrealized because you have not closed the trade. All right, so basically that's just it. So this is how to go into a sell trade, okay, on futures, a sell trade. If I click on orders now, it's going to show me my take profit and stop loss. You can see it here. You can see my take profit and stop loss. Stop loss is 8.740. Take profit is 8.000. So I want to close this right now. I want to close everything. Now, imagine we're actually going to take a buy trade. Imagine we're going to take a buy trade at market price. At market price. The same thing we did. All right, but we're taking a buy trade, our stop loss will be what? Lower than the current market price, will be lower than this guy right here. To be lower than this. So let's say our stop loss is going to be 8.10 because we are predicting the market wants to go up. We want to buy, the market will go up, right? So imagine the market goes down. Where do you want to leave the market? That's why you need a stop loss. It will prevent you from further damages. So we want to leave the market if the market falls down to 8.1, let's say 8.1, and our take profit, we want to take profit from 9.144, 8.1, 9.144. So I'm risking $0.65 to get $1.22. So I just click on buy. And voila, my trade is already running. Scroll down, you can see my trade is running. My orders here, you can see we have our stop loss and take profit right there. So let me just cancel this, right? Let me cancel this. Let me just cancel this right now. So that's a possible scenario, right? Now, imagine we want to buy at limit price. We want to buy, let's say we're predicting that the market wants to go down. The market wants to go down to 8.3 before it pumps. We just have to come here the same way we did it on spot. We just have to come here, put the figure 8.302. It's already there because I touched it on the screen. As I'm moving it on the screen like this, to be moving here. So imagine I want to buy from here 8.296. I'm not buying with my entire portfolio. I want to buy with just 25% with 5x leverage on cross. And my stop loss is going to be somewhere around 8.1. Stop loss is 8.1. Take profit is 9.1. So I'm risking $0.16 to get $2, right? So I just click on confirm. And it won't show under positions now because it's a limit order. The trade is not running yet because price has not gone back there to fill it. The order has not been filled. So we don't expect to see it under positions. But if price goes down and touches this amount we put in, that limit price, the trade will get triggered. All right, so let me cancel this. So basically, that's how you can do it. So you see, you can make money by predicting the market wants to go down on futures, and which was what we did initially by selling, by taking a short trade. All right, so basically, this is just how it works.